In Sub-Saharan Africa, it's estimated there are 44 million small and medium-sized enterprises, or an SME. In Africa, SMEs are estimated to provide approximately 80% of the jobs on the continent, and thus they're one of the main drivers of economic growth. Obviously, COVID-19 has had immense economic impact across the globe, but in Sub-Saharan Africa, COVID-19 since 2020 has caused approximately $115 billion in output losses, and that's caused an estimated 3.3% contraction in GDP. SMEs, because they're smaller, because they have fewer resources, have been particularly hard hit, given simultaneous shocks to both supply and demand. At this moment, they're desperately in need of financing to help them get through this, to maintain payroll, to keep folks employed, but at the same time, they're facing financial institutions that are hesitant to lend to them because of perceived risk. If African SMEs do not receive additional financial support, the effects of the pandemic will really be extended and exacerbated. Even before the pandemic, SMEs faced a challenging space, including the ongoing threat of climate change. You already see changing weather patterns that have affected agricultural production across the continent, whether it's because of unpredictable rainfall or weather patterns that will destabilize markets, make agricultural investors more reluctant to invest in the sector in Africa, and by extension, further curb economic growth. Some SMEs on the continent are already innovating to take on this challenge. So, for example, in Niger, Alue Sesame is an SME that grows white sesame, and they have sought to restore 100 hectares of degraded land by planting trees. This planting then helps the business's crops withstand recent increased rainfall as the trees actually absorb that water. African SMEs in the energy sector are also working with development finance institutions, DFIs, and other development actors to prepare for and mitigate the effects of climate change by investing in sustainable and renewable energy. And SMEs are working to increase access and durability of African transportation. So SMEs are trying to adapt so that they can, in fact, meet the challenge of climate change. But African SMEs face two major financing challenges. First, the ability of SMEs to access finance, and second, the cost of capital. High interest rates often deter SMEs from even applying for financing. Currently, 51% of African SMEs require more funding than they have access to. But the U.S. can offer guidance and assistance through blended finance. Currently, blended finance has been able to mobilize approximately $152 billion in private capital across all developing countries. Blended finance is one way in which DFIs or other bilateral donors can help mobilize private capital into developing countries and fill the significant financing gap that exists there. There are 5 different tools that DFIs and other development actors can use in blended finance models. First, loans offered at a concessional rate make it easier for SMEs because they'll pay less over the lifetime of the loan to the financial institution. Second, equity is helpful for companies when they're looking to grow. An investor will take an ownership stake, a percentage of a company, in return for an infusion of cash. The third tool are guarantees. Development actors use guarantees to take responsibility for future liabilities that would have impacted commercial lenders. A DFI or other investor would promise to take the first loss should a company struggle to meet the terms of that loan. Fourth are grants. This is money that comes with no strings attached. This is most frequently used for early stage companies that have an idea that they've not yet proved. This needs to be used very selectively, as crowding out private investment will make it more difficult for companies to be sustainable in the long term. Fifth and finally is technical assistance. It's frequently used to provide additional skills training to a business, for example, on the financial side or on the corporate governance side. These are the 5 tools that DFIs and other development actors can use to create blended finance. They are used alongside one another to catalyze private capital into developing countries. Beyond blended finance, DFIs and other development actors can work with local financial intermediaries, lenders, and other financial institutions to help strengthen the local financial systems across Sub-Saharan Africa, creating guaranteed lending lines with the bank, helping to inject additional liquidity into the overall financial system, and thus creating more opportunities for SMEs to tap into local finance to support sustainable local growth in the future. To make a difference in these local financial systems, DFIs and other development actors must understand other actors at play in Sub-Saharan Africa. China is now a major investor on the continent. Chinese investment over the past 2 decades has grown dramatically to $44 billion by 2019. Local populations have benefited from the job creation that has come from Chinese investment, both in Chinese-owned firms in Africa, but also on infrastructure projects. But a lot of what they have provided is actually in the form of sovereign debt to help build local infrastructure. The lack of Chinese investment directly into African-owned SMEs does offer the United States a clear opportunity to bring its own comparative advantage. The United States is not going to compete with China on a dollar-for-dollar basis, but it can bring 3 things that China does not bring to the table. The United States brings the gold standard in environmental, social, and governance standards for the private sector. In adopting these U.S. standards, it means that African SMEs are compatible with U.S.-based companies, with European-based companies, opening up new opportunities for trade and investment. U.S.-based firms can offer both high-level and low-level technology transfers to many African SMEs, and with the proper safeguards, are willing to do so. The final piece of the model is knowledge transfers. Knowledge is different from technology in that it will help improve business practices, corporate governance, and other internal business standards that will allow African SMEs to continue to grow and operate in a more interconnected world. SMEs are critical to the economic growth of Sub-Saharan Africa, and that has been recognized by the US government in the past, but more can be done. Blended finance is a tool that is an important comparative advantage that the United States can bring to its relations on the African continent. Blended finance gives entrepreneurs, the driving force behind SMEs, the financing they need to fulfill their dreams, to create better opportunities for their employees, and ultimately to build and sustain the economic growth that will improve the lives of others who live in their communities. If the United States plays a stronger role in creating greater access to finance for SMEs in Sub-Saharan Africa through blended finance, it will pay dividends by creating sustainable local economies that can help generate the growth and the resources needed to drive these countries' own development journey forward.